Hello, property navigators. Melbourne boasts Australia's strongest long-term property record over the past 40 years. But right now, after a few soft years, it's wearing the same underperformance badge that Brisbane and Perth did 4 years ago. Melbourne's median house price is around 41% less than Sydney's. That's a $600,000 price gap for houses, the most it's been in 2 decades. But why does that matter? Because historically in Melbourne's upswing phases, that gap narrows considerably. The data shows Melbourne snaps back the fastest out of all the capital cities once interest rates start falling, and Domain is already tipping it to be a leader of capital growth over the next 12 months, saying 10 to 15% growth within 2 years is reasonable. Right now, prices are well below replacement costs, so when the catch-up comes, today's discounted prices means inbuilt equity. You're effectively locking in gains before the upswing even begins. Add to that the big build infrastructure blitz, a strong jobs market, surging rents, and over 100,000 new residents now piling in each year, the rebound that's coming is unmistakable. That's the data we're going to run through today. Let's go. So what the hell is metropolitan Melbourne? In simple terms, it's the same as Greater Melbourne. 31 local government areas, with some extending into nearby regional areas, that cover around 9,900 square kilometres. Within it are about 340 suburbs, spreading more than 40 kilometres to the south, 30 kilometres to the east, 20 kilometres to the north, and sprawling across vast, flat basalt plains to the west. A map of Victoria is on screen, and the yellow shaded area is considered Greater Melbourne. Anywhere outside of this yellow shaded area, i.e. the blue part, the state government classifies as regional Victoria. The city of Melbourne itself is a very small LGA of around 37 square kilometres and is nestled within the Greater Melbourne area. It includes the innermost suburbs that share borders with 7 other LGAs. But today we're not just talking about that one very small city of Melbourne LGA. We are discussing Greater Melbourne, the whole thing, all 31 LGAs and their 340 plus suburbs, which includes the city of Melbourne. The Victorian Planning Authority delineates Greater Melbourne into 6 smaller sub-regions that each have their own identity and market dynamics: inner, metro, inner southeast, north, west, south, and east. Each region has a number of LGAs and even more suburbs within, as I mentioned, over 340. These aren't necessarily strict boundaries, but the key point here is that Melbourne is many markets in one, and timing market entry into each is unique. So don't get caught up in the trap of thinking Greater Melbourne is just one market. Zooming into these regions, we have inner metro and inner southeast, the CBD and surrounds, including the city of Melbourne. Think dense apartments, heritage terraces, big employment hubs, and historically higher prices per square metre. Eastern, stretching from upscale inner east LGAs out to middle-class middle ring areas. This corridor has a reputation for the classic eastern suburbs premium, but also has pockets of new affordable estates further out. Northern, from the trendy inner north out to growth areas like Craigieburn and up towards Mitchell Shire, a mix of gentrified neighbourhoods and new suburbs attracting young families. Western, historically the cheaper side of town, the West has been catching up fast. It's now one of Melbourne's fastest growing quadrants in population terms, thanks to affordable land and massive infrastructure upgrades. Southern Bayside and Peninsula, from Port Phillip Bay's urban beachfront down to Mornington Peninsula, where metro meets coastal lifestyle. This region benefited hugely from the pandemic-era sea change trend and remains a desirable mix of city and sea. Roughly 5.35 million people call Greater Melbourne home, about 77% of Victoria's entire population and 19.7% of Australia's national population. And it's growing fast. The latest ABS figures show Melbourne had the largest population growth in the past year, up by 142,600 people, or 2.7%, absolutely crushing any other capital. And looking forward to 2035, the Centre for Population 2024 statement has Melbourne projected to be one of the top 2 fastest growing capital cities, in terms of percentage growth rate being very similar to Perth. These projections show Greater Melbourne will be the highest growing capital city by sheer number of people and is expected to reach 6.4 million people by 2034 to 2035, bringing it to within 0.5% of Greater Sydney's population. That's massive growth. According to the State of the Victorian Labour Market report, Greater Melbourne carries roughly 3/4 of Victoria's 3.6 million jobs. Over the past decade, it has absorbed over 754,000 extra workers, pushing the participation rate, which is the proportion of people employed or actively looking for employment, to a near record of 67.6%, up 2.8% over the past decade. The unemployment rate is very low and has declined by 1.9% over the decade, from 5.6% to where it sits now at just 3.7%. Job vacancy rates linger at 2.8%, well above the pre-COVID norm of 1.7%. In practical terms, there are only about 1.3 unemployed people for every advertised role. So firms are still jostling for talent and payrolls keep expanding. Looking forward, Greater Melbourne alone needs 277,000 additional workers by 2026 and around 392,000 by 2027. More than half of that demand will land in 4 sectors: healthcare and social assistance, education and training, professional and scientific services, and hospitality and tourism. For investors, such concentrated, high-skilled job growth is a double tailwind. It anchors long-run tenant demand around hospitals, universities, innovation precincts, and CBD fringe corridors, while the big build and housing construction will funnel thousands of well-paid tradies into Greater Melbourne's growth area suburbs. In short, the state's labour market outlook all but guarantees that the right metro pockets will keep finding tenants and, in time, buyers faster than new supply will be delivered, which we'll analyse shortly. Melbourne's property market has been on a bit of a rollercoaster ride the past 5 years, but has posted 4 consecutive months of home price growth so far in 2025. This represents a notable turnaround as Melbourne property prices fell almost consistently from 2022 onwards, bar a month here and there. To briefly recap, post-2020 ultra-low interest rates and a brief frenzy pushed values to record highs by early 2022. Then the brakes slammed on. Lockdowns made most residents hate their life, and people left Greater Melbourne in droves. As interest rates surged in 2022 and 23, demand pulled back, and the market went into a downturn. Still, in March 2025, dwelling values are 3.3% below their May 2022 peak. Melbourne was the only capital with negative annual growth in the year to January 2025, where prices were down 3.4%. Prices lagged so much that Brisbane's median actually overtook Melbourne's for the first time in 14 years. What this enormous divergence in growth has meant is that home prices in Melbourne are now low relative to other capital cities. Why the underperformance? Data points to a few factors. Melbourne had a larger pandemic hangover. Extended lockdowns and closed borders saw the city lose 61,000 people just in 2020 and 2021 alone. Following that, even more Melburnians packed for Queensland or regional areas. Probably has a lot to do with a lack of confidence in the state government, but this meant that Melbourne market missed out on the COVID boom that every other capital enjoyed. As of early 2025, the percentage change in housing values saw Melbourne was the weakest of any capital, only up 12% since March 2020, whereas Brisbane, Adelaide, Perth saw massive jumps, and every other state also way up there. Another factor is supply. Melbourne has consistently had both more established property listings and new property supply than other capital city markets. From 2022 onward, Melbourne's property listings didn't drop. Just look at it. This kept a lid on price growth compared to Brisbane, Perth and Adelaide and most other capitals. The stock plummeted from 2022 onward. A crucial dynamic was the exit and re-entry of investors. Over 2022-23, a lot of investors sold off properties, especially in Metro Melbourne. In fact, the number of rental properties statewide fell by 24,500 in 2024 as investors exited the market. As of May this year, 27,800 rentals have disappeared from the market, according to data from the Department of Families, Fairness and Housing. The biggest drop in this rental stock was in metro areas, down 4% versus 1.4% in regional. Many citing unfriendly Victorian policies, such as a higher land tax burden, new stricter tenancy laws, unfavouring of landlords, and interest rates that made holding costs skyrocket. all of which made so many investors think twice about buying or even staying in the market. More people were selling than buying, and there was less investor FOMO than in other states, where prices were accelerating as Melbourne's prices were just stalling. Now, the good news, the fact that Melbourne's housing market has not performed as strongly as some other capitals over the last few years creates a window of opportunity as property values have significant upside potential. And 2025 has marked a turning point. After bottoming out in late 2024, home values have started climbing again, albeit modestly. Melbourne's notched 4 consecutive months of price growth in early 2025. We're not shooting past record highs yet. As of June, values are still around 3.9% below their March 2022 peak, but the trend has flipped to positive. In fact, Domain predicts Melbourne will lead price growth after Sydney over 2025 and 26, with house prices forecasted to rise about 6% over the next year. The expectation of easier credit and Melbourne's inherent affordability relative to Sydney are key reasons behind that forecast. On the rental front, Melbourne's swung from glut to crunch in a dramatic fashion. During 2020, inner-city apartments emptied out and vacancy skyrocketed. But as students and immigration flooded back in, the oversupply turned into a shortage. Vacancy rates plunged to record lows, hovering around 1% in many areas. Even the inner city now sits near 2% or below, which is considered a tight rental market. Rents responded accordingly. Over 2022 and 23, Melbourne's rents rose at the fastest pace on record, 15 to 20% cumulative increases in some areas. By very early 2024, rents hit an affordability ceiling and growth slowed to about 2.5% annually as of April 2025. But that breather might be temporary given the demand pressures. The key point is that rental yields have improved. Gross rental yields are sitting at 3.7%, up significantly from the sub 3% yields during the 2017 to 2019 boom times. In certain pockets, the yields are eye-popping. CoreLogic data from December 2023 to November 2024 shows Carlton units were yielding 7.8% on a median $448K price, thanks to steady student demand, and CBD apartments yielding 7.4% on average. Even affordable house markets are delivering. For example, Coolaroo in the north with a median $545K house price and an average 4.9% yield. Now, I'm not saying to jump out and buy in these areas anymore, but it's to illustrate that in the right markets at the right time, great deals can be found, and they still can be. One reason rents are so high is that new housing supply has not kept up. Building approval numbers in Victoria have plummeted. In the 12 months to June 2024, only 51,500 new dwellings were approved statewide, the lowest annual number since 2013. This construction downturn means fewer new homes coming to market in the next 2 to 3 years. For investors, low construction could translate to less stock, therefore less rental competition, meaning a tighter rental market in the medium term, a recipe for capital growth and rental increases if demand holds. Hitting housing supply targets with approvals this low is probably never going to happen. So until the supply side levers do kick in, the imbalance favours landlords. The consensus among major analysts is cautiously optimistic. With the Reserve Bank likely to continue cutting rates, buyer sentiment should continue to improve. Domain's FY 25-26 forecast has Melbourne house prices at plus 6% and units at plus 5% growth. That would officially take us past the previous price peak, setting a new record for houses, with units only 3% below their past peak. The drivers here are surging migration and tight rental conditions, and the fact that Melbourne's affordability is better than Sydney's. Investor activity is expected to pick up as well. As interest rates fall, yields will look very attractive in Melbourne given current rent levels. A potential headwind in the short run is the economy. High inflation and any large uptick in unemployment could sap housing demand. But as we've analysed today, Victoria's job market has been solid so far and looks to be strengthening considerably in the long run. On balance, expect moderate price growth in 2025-26. Domain suggests that Melbourne will record a noticeable acceleration and lead most other capitals in percentage terms over this time, remembering it has more room to rebound. Rental growth will continue to calm as it can't keep rising at near double digits annually forever, and we have seen it come down and stabilise already. But with vacancy rates so low, rents will likely trend up over the year, barring any economic shock. Here's where it gets really interesting. Melbourne over the medium term has some huge forces at play. By 2034, Australia's Centre for Population forecasts Melbourne to add roughly 1.1 million more people, taking it to 6.45 million. The Victoria in Future Government report projects Melbourne to increase its population to 8 million by 2051. For property owners, that long-term demand story is compelling. Accommodating that will require a housing construction boom, or else prices and rents will be under persistent upward pressure. In fact, 1.3 million additional dwellings are required to house the extra population. And that doesn't take into account the shortage we already have. So the housing numbers required are actually much more than that. And the odds of that happening are pretty damn slim. In the medium term, supply will gradually respond. We might see an uptick in apartment construction as developers take advantage of the tight rental market, but it will take time to translate into completions. So for the next 3 to 4 years, housing supply will likely remain constrained, especially in desirable established suburbs. On the interest rate front, the medium-term outlook is actually positive for property. We just went through the fastest rate hiking cycle in a generation. Now the pendulum could swing the other way. Most economists expect borrowing costs in 2026 and 27 to be lower than today, which would boost buyer budgets and investor cash flow. Melbourne is known as a rate-sensitive market, so we could see a stronger upswing during a rate cut cycle because historically Melbourne has very active cyclical swings. Domain's chief notes that Melbourne's market responds more quickly to interest rate changes than some others, implying that once more cuts commence, Melbourne might accelerate. Price outlook, well, it's always tricky to forecast exact numbers, but Domain analysts predict a moderate case could be mid-single-digit annual growth for the next few years, say 4 to 6% per annum, assuming no external shocks. That would mean new nominal price peaks by 2026 and steady gains thereafter. Some are a bit more bullish. A few experts forecast a return to double-digit growth in 2026 if rates drop sharply and supply stays tight. So keep an eye on credit conditions and lending policy that could spike demand. For example, if APRA loosens serviceability buffers. Also watch the macroeconomy. If we get a proper recession, then bets might be off for the short term, but even then population growth provides a solid floor under housing demand. Over a decade or more, Melbourne remains one of the best bets in Australia for property investment due to its diversified economy and sheer population trajectory. The city is projected to eventually become Australia's largest and needs over 1.3 million properties to house the growth alone. That implies a lot of development and rising underlying land values in many areas as scarcity increases. Major urban renewal projects will create new hubs of activity, potentially lifting values in underutilised areas. The risk to long-run growth would be if housing supply massively overshoots, which seems unlikely, or if there are policy changes that alter demand dynamics. In summary, the short-term outlook is cautiously positive. The medium-term outlook is strong barring economic mishaps, and the long-term outlook reinforces Melbourne as a growth market, albeit one that will have its ups and downs along the way. Now, a key piece of the puzzle for medium and long-term growth performance is infrastructure and urban development. Melbourne is in the midst of an infrastructure boom. The famous Big Build is the largest spend in the state's history. So big that we've had to make an entire video specifically on infrastructure to explain in enough detail how it's reshaping Greater Melbourne's property landscape. Keep an eye out for this video where we will cover all of that for you. Very important. Hit subscribe because we'll release it pretty soon. Overall, Melbourne's property market is entering a new phase of its cycle. The bottom appears to be behind us, but the climb is gradual. Not a rampant boom, but a landscape full of pockets ripe for growth backed by strong fundamentals. Investors who do their homework while leveraging the data can find outstanding opportunities in these markets right now. If you want any help with that, just pick up the phone and call us or jump on our website to book a free, no obligation chat with Boyd and I. We buy property in Melbourne every week and we can answer all of your questions. Until next time, happy property navigating.